Real estate offers diverse avenues for wealth creation, standing as a cornerstone of many investment portfolios. It provides tangible assets that can generate both income and long-term appreciation. Understanding its various facets is key to strategic financial planning. Among these avenues, residential and commercial properties represent the two primary investment categories. While both share the fundamental goal of generating income and appreciation, their underlying mechanics and market dynamics differ significantly. These distinctions are crucial for any investor to grasp. The choice between residential and commercial real estate involves a careful consideration of risk, reward, management requirements, and market behavior. Each category presents unique opportunities and challenges. A thorough understanding of these differences is paramount for making informed investment decisions. Ultimately, an investor's decision must align with their individual financial goals and personal risk tolerance. What works for one investor may not be suitable for another. This comparative overview aims to illuminate these critical distinctions, guiding you toward a more informed investment path. Residential real estate investing primarily focuses on properties where people live. This category encompasses a wide range of property types, each with its own characteristics. These include single-family homes, which are often a popular entry point for new investors. The residential sector also includes townhouses and condominiums, offering different ownership structures and community amenities. Furthermore, it covers small multifamily units, such as duplexes, triplexes, and quadplexes, which allow for multiple tenants within a single property. One of the most appealing aspects of residential real estate is its relative accessibility for investors. The entry costs are often lower compared to commercial properties, making it a more approachable option for novice investors. This lower barrier to entry allows individuals to begin building their real estate portfolio with less initial capital. The residential market is generally considered more liquid than its commercial counterpart. This means properties can often be bought and sold more quickly, offering greater flexibility to investors. The consistent demand for housing ensures a relatively stable market, driven by fundamental human needs. However, the income and returns from residential properties are often lower when compared to commercial properties. The income stream is typically reliant on a single tenant or a small number of tenants. This concentration of tenancy can increase the risk of vacancy, as the loss of even one tenant significantly impacts cash flow. Management requirements for residential properties can be quite hands-on for the investor. This involves direct attention to tenant relations, including screening, lease agreements, and addressing concerns. It also necessitates direct involvement in maintenance and property upkeep, from routine repairs to emergency issues. Commercial real estate investing focuses on properties used for business activities rather than residential living. This broad category includes a diverse array of property types, each serving distinct market needs. Examples include office buildings, which house various businesses and professional services. Retail spaces, such as shopping centers, storefronts, and malls, also fall under commercial real estate. Industrial warehouses and distribution centers are another significant segment, crucial for logistics and manufacturing. Additionally, large apartment complexes with numerous units are often classified as commercial due to their scale and operational structure. Commercial real estate often demands a significantly higher initial investment compared to residential properties. This typically requires substantial capital or access to sophisticated financing options. The scale of these investments means a greater financial commitment from the outset. A key attraction of commercial real estate is its potential for higher returns. This potential is often driven by longer lease terms, which provide more stable and predictable income streams. Commercial properties also benefit from higher rental rates per square foot, contributing to greater overall revenue. Furthermore, commercial properties offer the potential for significant appreciation, especially in growing markets or with strategic improvements. The value of these properties can increase substantially over time, providing considerable capital gains. This makes them attractive for investors seeking long-term wealth accumulation. Management requirements for commercial properties often benefit from professional property management services. Due to the complexity of leases, tenant relations, and maintenance for larger properties, outsourcing these tasks is common. This approach significantly reduces the day-to-day burden on the investor, allowing them to focus on strategic decisions. The commercial market is generally less liquid than the residential market. Selling commercial properties can take a longer time, sometimes months or even years, due to their specialized nature and higher price points. This requires investors to have a longer investment horizon and greater patience. Commercial real estate is also more susceptible to broader economic fluctuations. Vacancy rates are directly impacted by business cycles, as economic downturns can lead to business closures or downsizing. Rental income is heavily influenced by industry trends and the overall health of the economy, making it a more volatile investment in certain periods. The investment size required for residential and commercial properties presents a significant distinction. Residential properties typically require less capital upfront, making them more accessible to a wider range of investors. This lower entry barrier allows individuals to start investing with more modest financial resources. In contrast, commercial properties demand higher capital upfront, often necessitating substantial financial backing or complex financing structures. The larger scale and specialized nature of these assets contribute to their higher price tags. This difference in investment size is a primary consideration for many investors. Income potential also varies considerably between the two categories. Residential properties often offer lower returns, characterized by more modest rental income and appreciation rates. While stable, the growth potential might be less aggressive compared to commercial ventures. Commercial properties, on the other hand, often offer higher returns, driven by larger rental incomes and greater potential for appreciation. Their ability to generate substantial cash flow and increase in value makes them attractive for investors seeking more aggressive growth. This higher return potential often comes with increased risk. The management style for each property type also differs significantly. Residential properties can be more hands-on for the investor, requiring direct involvement in tenant interactions and property maintenance. This direct engagement can be time-consuming but offers greater control. Commercial properties often utilize professional management services due to their complexity and scale. This outsourcing reduces the direct operational burden on the investor, allowing for a more passive investment approach. Professional managers handle everything from lease negotiations to facility maintenance. Market liquidity is another critical differentiating factor. Residential real estate is generally more liquid, meaning properties can be bought and sold relatively quickly. The consistent demand for housing contributes to a more active and responsive market. Commercial real estate is generally less liquid, with transactions often taking longer to complete. The specialized nature of commercial properties and the smaller pool of potential buyers can extend the sales cycle. Investors must be prepared for a longer holding period. Finally, the risk profile of residential and commercial properties presents distinct considerations. Residential properties typically have a lower vacancy risk, even with single tenants, as housing demand remains relatively constant. While vacancies can occur, the impact is often localized. Commercial properties can be riskier due to their sensitivity to economic conditions and industry trends. Higher vacancy risks are prevalent, especially during market downturns or shifts in business demand. This economic sensitivity means commercial investments can experience greater volatility. The choice between residential and commercial real estate investing ultimately depends on individual circumstances. There is no universally superior option, rather, the best path is one that aligns with your personal situation. A careful self-assessment is the first step in this decision-making process. Your financial goals play a significant role in determining the most suitable investment. Are you seeking steady, long-term income, or are you aiming for aggressive capital appreciation? Your objectives will guide you toward the property type that best supports your aspirations. Investor risk tolerance is another critical factor that must be honestly evaluated. Are you comfortable with the potential for higher volatility and larger capital commitments, Or do you prefer a more stable, albeit potentially slower, growth trajectory? Understanding your comfort level with risk is paramount. Thorough research is essential for success in either residential or commercial real estate. This involves understanding market trends, property values, and potential rental income. Knowledge is your most powerful tool in navigating the complexities of real estate. Due diligence is a mandatory step before committing to any investment. This includes scrutinizing financial statements, conducting property inspections, and reviewing legal documents. A meticulous approach minimizes unforeseen risks and protects your investment. Ultimately, a clear understanding of the market is required for success in either arena. Whether you choose residential or commercial, staying informed about economic indicators, local demand, and regulatory changes will empower you to make strategic decisions and achieve your investment goals.